Hey, good morning, everyone, and welcome to this Thursday, November 9th, 2023 edition of Trading Places Live at earningsbeats.com. Just want to give my son a quick shout out, Tyler, who produces the show here. It's his birthday today. So he's made a lot of really good changes here on the show. And I just want to give him a shout out. If you want to pass along some happy birthday wishes in the comments, I'm sure he'd like it. Dow Jones Industrial Average down 40 yesterday, so winning streak there came to a close. S&P 500, though, up 43.82. We went up right near that 43.93.57 level. That's the high that we saw back in mid-October. Trying to clear that. We're above both moving averages, and the streak stays alive. I think it's 8 days now on the Nasdaq, 7 days on the S&P 500. We got futures up again today. This is what a bull market looks like. Volatility index falling and prices keep going up. It's been boring and it's been slower, but they're going up. Nasdaq 100 up about 17 points. That was about 0.1%, same as the S&P 500. But look at this, the mid caps down almost 0.5%. Small caps, the IWM down more than 1% yesterday. And intraday was below gap support and the 20-day moving average, but we did see a little bit of strength late in the afternoon to hold that key moving average. Transports down again yesterday, down 23 points, but continuing to hold that 20-day moving average. So yes, small caps, mid caps, transports, those areas are certainly still lagging, but they're holding some key support levels, even though they've been selling off a little bit. Certainly underperforming the Nasdaq and the S&P 500, but so far holding on to the 20-day moving average. I think things turn a little bit dicier technically if we can't hold that 20-day moving average. So let's watch that. Moving on to the sectors, we've got real estate, which is looks like was up about 0.6% yesterday. Technology up almost 0.6% as well. And there's energy, what I was talking about, down another 1.25%. And you can see it's been a pretty big slide over the last few days. And if you go back to mid-October, that's when the market was higher. We got here was the S&P 500 high. There's that Nasdaq high. The major indices pulled back and then came roaring back. Energy pulled back, had a little bit of a push back to the upside, and then sold off and took out a double bottom support area right at about the 84 level. Going down, closing yesterday at 82.75. So on the way back up, watch for around 84. That would be your first area of resistance. And then we've got the 20-day moving average, which currently comes in up at 86.61. So those would be the two levels to watch first on energy to see if we can get through. Looking at the strength yesterday, this is kind of a different group. We haven't really talked about toys. This is part of the consumer discretionary group. Breaking out to a multi-month high. Really nice day, jumping up more than 3.25%. This is a group that really on a relative basis has been a laggard for quite a while. So I don't know if this gets something started here longer term for the group, but you can see that volume bar down there at the bottom. Very, very, heavy volume to accompany this move and to accompany the breakout, which is always good. Then we got the airlines. So airlines, when you look at it, you think, wow, they're really moving back up through the 20-day moving average. But when you look at it on a relative basis, this is a group that's still struggling. So I like the fact that we're bouncing, but this is still not a group that's healthy. It's got a lot of work to do, especially on a relative basis. But even on an absolute basis, getting back through that 50-day moving average is going to be the first obstacle for this group. And then I just wanted to point out again, these are the gold miners. They were down 4.6% yesterday. And anybody who looks at gold and looks at the long-term chart and says gold looks good, I just encourage them to look at one more thing. Look at gold relative to the S&P 500 because it is continuing to lag as we get this big bounce back up, rebound in the S&P 500. Gold and gold miners and so forth, you can see pushing to new lows. The relative strength in gold miners, or just miners in general, all of them are absolutely horrible. And one of the things I talk about with gold does really well when fear escalates. When the volatility index is trending higher, that's when you typically see outperformance in gold. when the volatility index is doing what it's been doing over the last 7 to 10 days, that is not good for gold. The volatility index coming down, fear has been coming out of the market, and gold has been an awful relative performer. So don't just look at the price action and think, oh, people start talking about gold, up near $2,000 an ounce or above $2,000 an ounce there just recently. Look at the relative strength. That's what I think is really important. I think anybody who's a gold bull is somebody who is completely ignoring relative strength, or in the case of gold, relative weakness. Moving on to the 10-year Treasury yield, let me give you an update here on this chart. 4.55%, so we are up about 3 basis points right now. We are down below the 50-day moving average. Now, yesterday was the first close below. We'll see what happens. We've gone back over the last several months, and we've tested the 50-day moving average, but yesterday was really the first definitive close that we've had below the 50-day moving average, going all the way back to May. So this is a little change in character on this chart. And of course, it comes after that negative divergence printed that I talked about several weeks ago or a few weeks ago, where I thought we would come back, test this area between right around 450, 460. We've done that. I would watch it, because if we make a move and stay below, say, 450 for any kind of period, a couple days, 2-3 days, that would really start to turn this chart looking much more bullish for bonds, bearish for the yield. So keep in mind, they always are 100% inverse. So when you see the yield coming down like this, it means bond prices are going up. Now, usually bond prices don't go up as strong as stock prices. So it's not like I would say go jumping into bonds, but bonds, if the yield continues to decline and we get that definitive break below 450, I think the bonds will rise in value. I think we will continue to see some additional strength in bonds, continuing to send the yield lower and lower. I said yesterday, if we get a breakdown below this head and shoulder top, that would measure down to about 410 on the 10-year Treasury yield. Right now, again, we're at about 454. I've been speculating that maybe what we're going to do is maybe move back up somewhere into the 465, 470 range, possibly maybe 480. That would be more of a symmetrical head and shoulder top, because that left shoulder, we never got to close over 480. The head, we never got to close over 5. So if we get back up to around that 480 level, I mean, this would be an absolute perfectly symmetrical triangle, or symmetrically head and shoulder pattern, sorry. So this is something to watch for, I think. And if we did make that move back up in the 10-year Treasury yield short term, it could be something that Fed Chief Powell says, or one of the Fed presidents. Anyone could say something kind of from that realm of the market that could spook investors for just a few days, where we could get a little spike. I mean, I'm not ruling that out. And then what I am expecting, though, I would say the odds have risen that we're going to break down below this 450 area, maybe move back down toward 4 to 410, maybe 420, somewhere in that range. And that would likely continue to spur buying in U.S. equities, especially in those large cap growth stocks, which is where we're seeing the money rotate right now. I want to see more participation from the small caps. I want to see the IWM jump, move back through that 50-day moving average, and actually start to show a little bit of relative strength versus the QQQ, because we have not seen much of that at all. In fact, if I pull that up right now and we just look at that on a relative basis, look where we closed yesterday. New low. So IWM small caps just keep dropping relative to the QQQ. And I'm in both, but I'm weighted more toward the QQQ. I really want to weight more toward the IWM, but I got to see it on the chart. I mean, again, look at this chart. There's nothing here to like. Today, it looks like at the open, we're going to get a little bit more relative strength in the small cap area to open. But we've seen that before. In fact, if you go back 4 days, this is a 5-day chart of this relative relationship. Look back to last Friday. We had a major gap up on a relative basis in the IWM versus the QQQ. And look what's happened since. It's just been going down, down, down for the last 4 days, steadily. So today, we're probably going to get another gap. But do we start to trend higher? Or is it a situation where we just start trending lower again and the QQQ continues to outperform? I'm waiting on some kind of a change in this trend before I even consider moving anything more toward the IWM. We had a great trading room session yesterday, by the way. Talked about a few more stocks, talked a little bit about the IWM, and because I had some members asking, is it time? I'll show that IWM. Actually, let me get to the IWM chart and we'll talk about that. First, let's go over the S&P 500, and I'll talk about the comments from the trading room. Here, you can see we're right there. Yesterday's high, 43.91. The high from back in mid-October, 43.93.57. So we got within a couple of points. Today, it looks like maybe we're going to open up, I don't know, possibly up another 8 to 10 points. That's going to get us pretty close. We'll probably be somewhere around the 43.90 level at the open in 17 minutes if it holds up, if futures stay green. So we could be right up challenging that level. We could break right out here. There's no guarantee. I just think, I pointed out the 10-year Treasury yield. If it goes up, back up, we might get a little pullback here in the S&P 500. And that would line up with the 60-minute negative divergence, which I can pull up here. You can see as the S&P keeps going up, this is just a 1-month hourly chart. But over the past few days, as we've been trying to move higher and higher, we're getting a negative divergence. And all this is taking place right at this major top. So if you're going to have any kind of concerns about the market, it's probably right now, and I'm talking about the stock market, the S&P 500. This is it, because we're up against what I consider to be a major resistance level in the correction from the correction we had. Lower lows, lower highs. This was the last lower high. So if we break back up, you start seeing 4,400 print. That correction at that point technically is over. I said it was over a week ago, but that would confirm it. It's kind of like when I called the bottom in 2022. We didn't actually confirm that the downtrend was over until we went back through 4,300 on the S&P 500. I started talking about a bottom at 3,600 because of my signals. But you don't get the technical price action and that confirmation until you break the series of lower lows and lower highs. So that's why, bears are going to want to defend this level, and we've been seeing it. We're struggling here. We could pull up the Nasdaq 100 on the hourly chart. You're going to see the same thing. Higher prices, lower PPO. How about NVIDIA, one of the leaders? What do we got here? Higher prices, lower PPO. How about Amazon? What's Amazon doing? Higher prices, lower PPO. We go across the board, but how about Microsoft? What's Microsoft doing? Higher prices, lower PPO. We've got but these are short-term negative divergences. Many times they can be rectified in, I always say it's like 1 to 3 days. So this isn't a long-term bearish call. It's just a short-term cautious call. So if you're in leverage, I would be out of leverage. I don't think sitting at resistance is not the time to be in leverage. Breaking through resistance is a good time to be in leverage, but you got to see it. You can't anticipate. If you expect that we're going to go right through key resistance and then we don't, leveraged ETFs are going to be painful on the way back down. So now is the time to take the profits from this recent move to the upside and let the market tell us when it's safe to be back in to leverage. All right, let's keep moving here. Nasdaq 100. I showed you the hourly. Here's the daily. Same thing as the S&P 500. Trying to get through that mid-October high. The IWM. So this is what members were asking. We're going back down. We're testing the 20-day moving average. Gap support. Is this the time to jump in? And what I said yesterday is I want to see some relative strength. Sure, you could play it off the 20-day because you do have a very tight stop. It closed below the 20-day. You can get right back out. But I want to see relative strength. I want to see that this group is actually starting to perform well. And the last few days, it's been the opposite. You can see last 3 days, red-filled candles, meaning not only are we down, but we're closing below the low each day, 3 days in a row. Meanwhile, you can see the Nasdaq 100 now has gone up eight days in a row. Or is it 9? Or 9 days in a row, my bad, 9 days in a row. So, I want to see that turn. I want to see that rotation back into the IWM. before I would get more aggressive with the leverage. So right now I'm in the IWM, I'm in the QQQ, but like I said, I'm skewed more toward the QQQ, and I'm waiting. I want to see a little bit more strength in the IWM. Transports trending lower. You can see this nice recovery. We have now traded above the 20-day moving average for 4 consecutive days. That is noteworthy. When we've gotten up before here, back in August, we went through 1 day, swiftly back down. Next time we had 2 days and then back down below the 20. Then we came back up one more time, one more head bob, and then back down we went below water. And big sell-off. This time, 4 days in a row now hanging above the 20-day. I view that as pretty bullish. Still got overhead resistance. We've got to get through 14.6. Got to hold the 20-day. Need to get through the 50-day. Certainly wouldn't say that everything is behind us in terms of technical problems, but things are looking better. And that's how you get started in an uptrend. Things have to start to look better. And we're trading a little bit more bullishly. All right, let's move on to the chart of the day. For those of you who are new to Earnings Beats, maybe you're tuning in for the first time, I really, just want to, let you know, first of all, we do this 3 times a day, and we're doing this to try and help folks out there manage their money. We're supported, obviously, by people who come in and pay us for our service. That is the Start Your No-Cost trial right there. It's a 30-day free trial. I will say this. I don't want pity money. I mean, that would be nice, but that's really not what we're looking for. If we're helping you, then think about subscribing. And if you like the service, those are the members that we really want. I like the stories where people were writing in saying, you know what, I never understood the stock market. I didn't realize how many different components there were and the things you had to watch and putting the puzzle pieces together. And I've got a lot of people saying, I don't watch CNBC anymore. Those are comments I love to hear, just because I think that is the path toward much more financial success in life. And of course, money's not everything in life, but it certainly helps, trying to enjoy things later in life and so forth. So hopefully we're, accomplishing our mission of providing some really good education and guidance and research. That's really what we do. That's our 3 pillars at Earnings Beats. But anyway, if you haven't tried us, try us. 30-day trial. You will have to give a credit card for this 30-day trial, but you won't be charged. We will actually reach out to you before the end of the 30-day trial to let you know that, hey, your free trial is ending. You're going to be charged, to give you ample time to let us know that you're not interested and you want to cancel. So anyway, give us a try. If you haven't, we'd love to have you on board. Also, I just wrote this report. Well, I did all the research, and my daughter Erin, also involved in the business. She's the one that does a lot of the creative work on some of these newsletters and books. And this happens to be a PDF that you can download. This is a free report. The first one, we have 2. The first one will give you a lot of great information about how the market trades. Click on that, download that free report. If you haven't seen it and you don't really understand how the market works seasonally, historically, you're missing a big piece of the market. Make sure you check that out. But if you scroll down further, there's our free newsletter. Earnings Beats Digest, name, email address, hit the subscribe button. Unlike our free trial where you have to give credit card for our paid service, this is not part of our paid service. This is just a free newsletter. No credit card required. You don't have to, you can unsubscribe at any time. You won't hurt my feelings. It's out there if you want it and if it helps you. Name, email, that's all it takes. 3 times a week, Monday, Wednesday, Friday is when we send it out. So let me give you an example. This isn't one that we did because it's not Monday, Wednesday, or Friday. It's Thursday. But we looked at Biogen, or I looked at Biogen. I want to go through a few things with you on Biogen. So the first thing is, you look at this chart, it's ugly. I mean, market's been rebounding. What did I say? Nasdaq up 9 days in a row, S&P up 8 days in a row, and Biogen is now at a 52-week low. This is not this without even looking. Hopefully you can say, hey, that's a bad relative performer. We don't need to see a chart to know that this one is not performing well on a relative basis. So the first thing I wanted to point out on this chart is just the fact that it's been downtrending. This is what you don't want to be in You might look at it and say, well, don't we have lower prices and a higher PPO? Yes, we do. But do you see anything that's convincing at this point that we've seen a bottom? Because if BIIB continues moving lower and we get down to like that 220 area, this PPO is starting to roll over. We may see a new low. That positive divergence may be eliminated. What you need to see is a reversing candle with a positive divergence. And I don't see one of those yet. Maybe you watch for it. But a big volume breakdown to me trumps any kind of positive divergence. You've got to get to a bottom. You need to see a reversal. So anyway, that's the first thing I wanted to show you on Biogen. But let's stretch this out. Here's a longer term chart on Biogen. And what you might not realize is that 2015, we set a high on Biogen that we have not seen on a monthly basis. We have not seen a close above that in the last 8 years, 8.5 years. So Biogen is definitely a stock that has been struggling. We've been in a bull market now for 10, 11 years, secular bull market, and Biogen's been doing nothing, going sideways. So that tells me right there, and look at the relative strength since 2014, even 2015, 2014, these highs. It's been almost a decade of Biogen underperforming its peers. Now, let me show you a few of the other stocks in this area. How about Amgen? Same long-term chart. Look at Amgen. Keep going. It keeps going higher. It bottomed relative to its peers in 2015 and is now trekking higher relative to the biotech industry. So a simple question, would you buy Amgen or would you buy Biogen? And if you didn't say Amgen, well, I'm disappointed. Everything we talk about with relative strength, but I'm gonna keep one-upping here. How about Vertex, VRTX? Look at this one. Vertex going up the whole time. Relative strength, actually, we kind of went sideways during this period when Amgen went down. And now we're moving up and we're sitting at a, multi-year, probably all-time high in terms of Vertex relative to its biotech peers. So I'd argue maybe Vertex is better than Amgen. And I got one more for you. How about SGEN? This was the old Seattle Genetics. So they changed their name. I don't know if that might have been a merger involved. I can't recall. But anyway, the name was changed. They went to SGEN. And look at this. I mean, we've been going up mostly for the last 15 years here in relative strength. This is one of your leaders. So it's not just about looking at BIIB and whether it's a buy or a sell. Look at it relative to some of the other stocks in its industry group, because it may not be a buy at all. And I would argue it's not a buy. I don't care if even with the positive divergence and everything else, these other stocks are doing so much better. So am I going to try and say, well, I think the 8-year relative downtrend is coming to an end? Well, good luck with that, because it hasn't worked for 8 years. I would stick with the ones that are showing relative strength. So I like Amgen better. I like Vertex better. I like Seattle Genetics, or SGEN now, better. I think those are all stocks that you can get behind if you want a biotech, a large biotech, and avoid Biogen. All right. I want to do one more thing, because one of the things, the title today was talking about how these cryptos have been so on fire of late. And so what I want to do is, first, I want to show you the chart, and we'll get an update here on the Bitcoin. You can see up 2,000 on this chart over the last 24 hours, going from in the 35,000s to almost 38,000, 37.5, moving toward 37.6. And if you look back just, the last few weeks, cryptos, and especially Bitcoin here, we've jumped from 27,000 to 37,000. That's a really big move in a short period of time. So Bitcoin is absolutely on fire. And I look at these cryptos as a little bit of like risk on, or an aggressive area of the market. I mean, this is aggressive when you start getting into these cryptos. And to see the aggressive money rotating so heavily into cryptos only makes me think more bullish thoughts about the S&P 500 and the Nasdaq and where the stock market's heading. When you start seeing money turn more bullish and more aggressive, that is the environment where stocks thrive. Just pointing it out. So I'm not a big fan of cryptos. I don't trade cryptos. I know many of you probably do, and that's why I wanted to point it out. Just the fact that they've been so strong and really picking up steam just here in the last day or so. But let's look at the relative chart. I'm going to bring up a RRG chart. And what I've done on here is just like with the S&P 500, I use the benchmark as the S&P 500. And then I look at all the other stocks or industry groups or sectors and how it relates to the S&P 500. Well, I've done that here on the RRG chart. And I'm using Bitcoin as the benchmark, much the same as I use the S&P 500 as the benchmark for stocks. And then I put all these are mostly the other cryptos that are covered at StockCharts. And so mostly the cryptos that you all are going to be familiar with. Maybe there are others out there. I don't follow all of them. But I thought it would be interesting to look back. This is a 10-year monthly RRG, and I've got a tail on here of 6 months. So each one of these is just showing you what's been happening over the last 6 months. Have these other cryptos been outperforming Bitcoin, or have they been underperforming Bitcoin? And over the last 6 months, I think you can see it is very clear that Bitcoin is your leader. I mean, it's probably the safest one. And I say that, tongue in cheek, because I don't really follow this stuff as closely as a lot of people do. So I just follow the numbers. But, I think that when you hear folks that are taking money or taking, they're using Bitcoin as their currency, that makes me feel a little bit safer when business to business is starting to use. I don't see that as much, or very, very rarely, with some of the other cryptos. So that's why I think Bitcoin is probably the safer. But if you're looking for something maybe that's better than Bitcoin, this is where I would start. Now, this is a long-term RRG, but you can see everything is really rotating versus Bitcoin. Anything that even was in the leading 5 or 6 months ago is now down into the weakening, or even all the way down into lagging. So I think from this chart alone, it's telling me Bitcoin is the choice. Now, I'm going to show you, let's take a look at one of these that I had followed a while ago, and it's probably the worst performer now. And that is ADA, which is Cardano, I think. And well, I can see down here, or Cardano, sorry. But if I click on this one right here specifically, it'll highlight it on the RRG. So you can kind of see whichever one you want to look at down here. Let's say you want to look at Ethereum, click on that. This is what it's doing over the last 6 months relative to Bitcoin. Not doing well. How about Dogecoin? Dogecoin getting killed over the last 6 months. And then again, how about Litecoin? Litecoin was actually leading for a while, but it has quickly rotated all the way back into the lagging quadrant. Now, it is 9:31. I could spend a lot more time. Basically, look at the vertical axis as momentum. So when it's coming down really fast, it's losing momentum on a relative basis. When it's on the horizontal axis, if you see it go really fast over here to the left side, it means that it's losing a lot of relative strength. So this horizontal axis is relative strength. The vertical axis is momentum, relative momentum. And so when you're moving in this direction, southwest, that southwest is the worst. You don't want to be doing that, because you're losing momentum and you're losing strength on, price strength on a relative basis. So relative momentum, relative price strength. Now, I pulled up Cardano on the chart and I looked and I said, well, look at this. It's doing much better in the short term. So then what I did is an RRG, and I did a 3-month daily chart. And if we look at Cardano now, in the short term, it's looking really good, right? I mean, it's leading. It's actually doing better than Bitcoin. So, but again, we're talking about 3 months. If we go and look at that longer term monthly chart and go back 6 months, it's the opposite. So we're showing short-term strength, but longer-term weakness. And so what I wanted to do here was let's pull up this relative chart so we can look exactly at what is going on here. That's ADAUSD. So here is that strength that we're seeing, right? But if I change this to monthly and we go back, 10 years, here's that little bit of strength that we're seeing right now. But does this make you feel good? I mean, we're in a long-term downtrend. We've had these little short-term bounces. This would worry me. I mean, I feel like I'm getting in after a bounce in a stock. It's not a stock, obviously, but if I bought a stock that looked like that, I'd feel like I'm getting in right after I had a little bounce. I'm probably going to go back down again. That's the way I would look at it. I need to see more relative strength, is I guess what I'm saying. I need to see this last for more than just 2 or 3 weeks. When we look at the long-term chart, Bitcoin remains the dominant crypto in my view. All right. And I liked Ethereum, like I said, for a while, but that Ethereum chart, I think I had that up here. Let me go back. Yeah, there's Ethereum. I mean, you can't argue with what the price is. I mean, this is beating me over the head. Ethereum has been underperforming for the last year. So I can like Ethereum all I want, but I'm going to lose money on a relative basis if I invest in Ethereum. And this has been dropping pretty rapidly of late. So even now, look at this. I mean, here was a little bounce in relative strength in the Ethereum and then right back down near the 52-week low. So I like to follow relative strength. I think it's Bitcoin. That's the one that I would be most interested in. All right, let's take a look at what's going on in the market. Maybe I'll take a look at any questions over here real quick. So we got the Nasdaq opening up a little bit. S&P 4388. Remember 4393, 57. That's the number. We're 5 points away. That's pretty close when we consider where we came from, down near the 4100 level. I mean, we're up almost 300 points now on the S&P from that low back on October 27th. I mean, this is a bullish period. We talked about it, and we have had just a huge, huge rise. But the bullish period, while the main bullish period ended, the rest of, middle part of November is okay. End of November, we pick up again. And then we go through a little bit of weakness from about the 5th to the 10th, probably about the 5th to the 15th of December. And then we usually finish very strong into the end of the year. So we might have a couple hiccups along the way, but I think the path is going to be to the upside. And by the end of the year, I fully expect we're going to be back to that 4,600 level, if not above it. I wouldn't be surprised. I still think there's a shot that we get back all the way to 4,800 and test the all-time high before the end of the year. I think the odds are greater that's in the first quarter of next year, but I wouldn't be shocked. I mean, we've been seeing money rotating into growth. Wall Street, they're telling us a sad story on CNBC, but they've been buying growth stocks throughout. So one part of Wall Street, I think, they're doing their job. I call them the influencers. They go on CNBC and they just say whatever they want to say, how bad things are. But then I look at the charts, and most of the money that goes into the markets from these big firms. It's not from you and me. And when I see rotation into growth versus value, what's Wall Street doing? I think they're speaking out of both sides of their mouth. So anyway, market goes up a lot more than it goes down. Stop trying to call tops. Stop trying to predict a market free fall. They don't happen very often. We just had a cyclical bear market. That was the opportunity. I think, it's over now. That opportunity, I think, is ended. I'm much more bullish. We'll probably have another, if we have a big year in 2024, maybe 2025, we'll have to watch out again. We've been getting these cyclical bear markets, seems like just about every other year. Maybe that's going to be the recipe for the next decade. I don't know. But I'd be really careful, just with a negative mindset all the time. And if you run into anybody who is always talking crash or collapse, I think it's clickbait. Anybody looking at the market long-term, looking at history, knows crashes and collapses don't happen very often. Maybe 2 to 3 times in your lifetime. Stop predicting crashes. Follow the market. follow it mostly to the upside. Anyway, that's it for me. I appreciate everybody tuning in. I'm going to be actually traveling this weekend. I will try to be on schedule with everything that normally comes out, but I do have an 8-hour drive, 2 different directions for a celebration of life and my family. So for those of you that are members, if things are a little late, I can't help it. It's just another big weekend to travel for me. But I will be back. We'll be doing the shows and everything on schedule for next week, Tuesday, Wednesday, Thursday again, for your Trading Places Live. So we'll be back. And we'll see how the market does between now and then. I think we've got those negative divergences. We've got the overhead price resistance. We got to deal with that a little bit here in the near term. So maybe we go sideways. Maybe we even have a day or two down action. But I do think by next week and the second half of November, I think we're going to be breaking out and charging toward that 4,600 level on the S&P 500. So anyway, thanks again. Let me see if we got anything over here in the questions. I got a couple minutes here. Cryptos or Kryptonite. Yeah, I just don't. I spend so much time on the market. I don't have time to research and do everything I do on cryptos that I do in the stock market. So I just don't have the information. They don't have a long history. So I just don't trust them as much. I just avoid it. I do fine with the market. I'm not trying to make a massive score. I think a lot of folks get into cryptos. Every time I talk to somebody who's in cryptos, it's gonna make them wealthy. And that's not why I invest. I do want to make money, but when you start getting those thoughts in your head, you sometimes become irrational. So just be careful. Just looking through here, what had happened to Dogecoin? I don't know. Like I said, I don't cover this stuff closely. I know a lot of people though that got into Dogecoin to get wealthy. I think if they just put their money in Bitcoin, they probably would have been doing better. But again, I don't really follow it, so maybe that's not true. Is there a cup formation on Microsoft and Apple? Well, Apple needs to go up a little bit more. I don't know. I'll just report to you what I see. You don't need to necessarily see the chart. I mean, yeah, Apple could be sitting at the right side of a cup. A pullback to the 20-day would be really bullish in that particular pattern. Apple's nowhere near filling out the cup. It needs to get up into the mid to upper 190s just to get back to where it was. I don't really see a cup there. Maybe something will set up like an inverse head and shoulder or something. But I see both in very bullish patterns. Can I comment on IHI? IHI. That is the medical device ETF. Well, positive divergence at the bottom. Actually, go ahead and throw this back up there, Tyler. It's harder to visualize, I think, without the chart. All right, so there's the lower low on IHI, and you can see the higher PPO. Went up, almost got to the 50-day moving average. Now we're back below the 20. I don't like this action moving back below the 20. I really would like to hold the 20. And keep in mind, when you see a positive divergence, what I'm looking for initially is just a move back up toward, it's nice if we get the test, but I'm trying to get through the 20, which we didn't do at any other point, really. So we did get through the 20. We were making our way toward the 50. We were trying to get back to the center line. This could be rolling back over. I'm thinking bullish thoughts about the overall market. So on an absolute chart, I expect most things to go higher, but clearly this is still a laggard. So it's kind of like the IWM. I need to see some relative strength, and we're just not seeing that yet. Okay, I think that's it for the questions. So again, just want to wish everybody a great weekend. Getting closer and closer to the holidays. So definitely everybody be safe, be smart throughout the holidays, and let's get safely into 2024. But that's it for this week. So have a great rest of your week, and let's see what the market does. And we'll talk about it again next week. Happy trading, everyone.